Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
In an exclusive conversation with us earlier, he said that stocks will move higher over the next 1 to 2 years.
I think the bull market is now reaching a stage where it is going to get backed by strong fundamentals. Now, obviously, there are a lot of risks along the way, and I think everybody is focused on those risks, which is usually a good time to actually engage in stocks. When people start disregarding risk, that's when I think you get worried. But for now, I think growth is looking good, likely to surprise on the upside. The profit share in GDP is at near all-time lows. So I think we're going to likely witness a very sharp recovery in corporate profit margins over the next 2 or 3 years.
Do you think political risk as well as interest rate risk can be very big caveats to your Sensex target?
The Sensex target is what it is. I don't think we should overly focus on this. Stock markets are forward-looking animals. They've already baked this in the cake, which is why we're getting such a muted reaction this morning to the additional tariff round. I think everybody can identify panic and over-exuberance. The market doesn't feel like that right now. It doesn't feel like it's in panic or it's in exuberance. So I would argue that stock prices are more accurately reflecting all these concerns than we can actually fathom. And therefore, I wouldn't really worry about these things. So many things can go wrong. And that's true about stock markets at any point in time. But I think we have to weigh those things against what could happen to fundamentals, where the valuations are. And I think on balance, it looks like we are in an uptrending market, give or take a few points here and there. And, will the Nifty correct over the next few days? Quite possible. But I think over the next year or two, I think it's likely that stocks are higher, not lower.
Now we've seen the leadership stocks correct quite a bit. Consumption, for example, has corrected. The NBFC twins have corrected. The retail banks have corrected. Your thoughts on the kind of leadership shift that we have witnessed over the last 3 or 4 months?
Performance breadth. I think that's one of the important things that we are citing in our report that we wrote last week, which is that we believe that performance breadth will widen from here. So the winners of the past few months or past few years, I think are going to take a bit of a back seat relative to the losers, where we think that fundamentals are inflecting. So for example, take the comparison of the banking financial sector and take NBFCs versus corporate banks. So very clearly the trade has been in favor of NBFCs against corporate banks, and we think that's going to flip because we think that the fundamentals for the corporate banks have troughed and there should be a meaningful improvement in earnings. And when I say meaningful improvement, we're not talking about 10-20% growth, we're talking about much more. Magnitude of 40-50% growth in earnings, and therefore 40-50% rise in share prices. Given where the valuations of corporate banks are, I think it's a trade which represents much muted downside risk versus upside risk. So it's a favorable trade for investors.
Both the fact that the Nifty itself has fallen from 11,800 to 11,350, as well as the currency has fallen. So are we on the cusp of the return of foreign investors?
Now the fact is that emerging markets around the world have got really smacked. I mean, India has been an outperformer, right?
Yep.
So there's a lot of value that has emerged emerged in emerging markets over the past few months because of the price damage that has taken place, and the currencies in emerging markets everywhere are down. India is not isolated in this regard. This is very different from 2013, where a handful of countries, including India, were hurt. So that all depends on the relative opportunity. So if there's a bounce back in EM, India will underperform. Now that may not matter to people at home, because if EM bounces back, then absolute Nifty levels will also rise, albeit slower than what other markets around the world experience.
The best performing sector this year, Ridham, has been the IT space, but your house has now become a bit cautious on that space. In fact, you recently downgraded Infosys as well. Is it only because of the run-up that these stocks have seen that you guys are cautious, or do you think structurally something is changing?
So Sonia, we downgraded technology to underweight on Friday evening. I think that the sector's relative earnings growth will look inferior to the rest of the market, because we expect domestic earnings to do a whole lot better over the next 12 months. Of course, performance has also been very strong, and valuations have also nudged higher. They're nowhere close to the peak relative valuations that technology used to have, say, 10, 12 years ago. But there's no reason to believe that it goes back there, because the earnings profile for these companies is now very different. But the key call is about relative earnings growth, which I think is going to be against the tech sector. And a lot of the rupee has also depreciated. So, bulk of the rupee trade is also in the price. So these are the couple of reasons why we've actually gone underweight tech. The sectors that we like are financials, mostly corporate banks, select retail and NBFCs. We like industrials, and we like discretionary consumption. And in fact, I'm underweight everything else.